Stability returns to this market. The bond sell-off eases. Google spared the fate of a breakup. 30 minutes until the start of equity trading. I'm Dani Berger. Matt Miller is off. Bloomberg Open Interest starts right now. Coming up, stocks stage a modest rebound after 2 days of losses, with antitrust relief for Google boosting big tech. Meanwhile, Macy's raises its outlook but joins a chorus of retailers warning of a consumer pullback. And in a week packed with data, today's jolts may show more labor market cooling. Let's look at some of the stocks on the move this morning because we have had some earnings, specifically retailers, to kick things off. Macy's up 14.8%, raising its annual outlook, reporting its best comparable sales growth in 12 quarters. Then there's Dollar Tree, also raising its outlook for 2025. More consumers looking for lower price goods, but investors are concerned about the sustainability of that growth. Shares down 6.6%. And the big story this morning, Google won't have to sell its Chrome browser as part of an antitrust ruling that analysts see as favorable to big tech. Let's dig more into this story because it is the boat that is lifting up all ships. And let's get into it with our Bloomberg Tech co-host, Caroline Hyde. Caroline, wonderful to see you this morning. You too. It's a really big win for Google here.
It certainly seems so. Look, this could open at a record high in terms of share price. We could see 7% pre-market moves spill into the actual market open. You're seeing the similar moves actually for Apple as well. These are the two key gainers on what, well, Moffett-Nathanson, the analyst over there, is saying they didn't just dodge a bullet, they dodged a missile here. So suddenly, all of that overhang on the stock price, that built-in worry and nervousness about regulatory impact, still lasts a little bit because there are some other investigations in the EU and the DOJ. However, for now, the fact that they don't have to sell off Chrome, the fact that they're only having to share a little bit of data, and the fact that the money still flows from Google to Apple means both of these companies have a big regulatory win on their hands. And you see so many price targets being upped by analysts. They have zero sales from the analyst community for Alphabet right now.
I saw Dan Ives writing that he's upgrading their price targets, saying that the government folded like a cheap suit. And I think we can say that the man knows suits. So there is that. You mentioned Apple. So how big of this and how necessary was this for Apple to continue to get their revenue from Alphabet on some of the Google Chrome search?
I mean, it's a good chunk of change, isn't it? About $20 billion per year. That's not huge in the gargantuan amount of revenue that Apple pulls in. But the fact that there's no costs involved, I mean, this falls straight to the bottom line. So from a profitability perspective for Apple, this was very necessary. And so we are still seeing the payments hold. This was almost the big win for both Alphabet and Apple in a longer term perspective. The fact that they're still able, that Google can pay for the area to get the PR basically for its search tools. You're not suddenly going to have to go immediately being presented with the alternatives. They can keep flowing money, and ultimately that's important for a lot of other companies' business models, was what Judge Mehta ultimately felt. But I think the real takeaway from this is that AI has changed the game. This is why Alphabet, actually compared to the other big tech names, is relatively lower valued. Even after this increase in their share price, people still feel that there is erosion of share that is coming away from search because generative AI has changed up the landscape. Perplexity's now in the game. OpenAI. There is that nervousness, which is why we're still seeing generally the shares and the company trade at a much lower valuation compared to peers. But more broadly, I think this is a huge weight and sigh of relief for the investor base of Alphabet, but huge sigh of relief for Apple in and of itself.
I mean, it is just this great irony that OpenAI's rise literally saved Google from a breakup. Yes. So there you have it. Caroline, thank you so much for joining on that. That is Bloomberg Tech's Caroline Hyde. Now, a pair of retailers have also boosted their outlooks. Both Macy's and Dollar Tree were out with earnings before the bell. Both companies, again, had a higher outlook, but you can see the difference in share prices. Macy's, though, warned of a fickle consumer. Bloomberg consumer editor Emily Cohen joins us now. So, Emily, let's tackle two of these separately because they're having a clear difference of reaction in the market. Macy's, a company that has long been trying to engineer a turnaround. Does this suggest that the turnaround is here?
I think the turnaround is starting. I think we're starting to see stronger sales in the 150 stores that Macy's decided to prioritize than the overall store base, which is a sign that Tony Spring's strategy is working. But yes, he did have some cautious signs on the call today, warned of a surgical shopper, said that price increases are here and also coming. So we're eager to see how shoppers respond during the holiday shopping season.
It's that crucial period when we don't really know exactly the full picture of the consumer. There's a lot of varying reports from these companies. So how does Dollar Tree play into this, considering that they also capture that lower income consumer?
Yeah, I think Dollar Tree is in a tough spot. I think expectations are really high for them. This is a moment for them. As consumers trade down, expectations are really high for these value chains. I think the street was expecting a bit more from them in terms of outlook for the current quarter, and that's why they're taking a beating this morning. But there's really strong signs on the sales side there, and they're benefiting from higher income consumers trading down and looking for value, and that's happening.
Yeah, it's something we've seen again throughout the earnings season. Emily, thank you so much for that wrap up.
Thank you, Dani.
That is Bloomberg's Emily Cohn. Now, in just 1 hour time, we're going to be getting JOLTS data, factory and durable goods orders. Let's look ahead to the data with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, set us up. What are we expecting from the data?
Well, JOLTS used to be really, really important, and then it wasn't because jobs were filled. When there were a lot of openings and the companies couldn't find anybody, we cared about the data. We haven't in a while. Talking with Mark Cabana from Bank of America this morning, he said, yeah, but now we got to pay attention to that and to ADP because we don't know what's happening with the jobs report. So with that in mind, we're going to be looking at JOLTS today, and we are expecting a slight decline. The quits rate isn't forecast, but the quits rate is something that everybody watches, including the Fed, to see whether people think they can get another job. And as long as that stays stable, it doesn't suggest the economy is falling down. Factory orders is going to be really interesting as well. This is sort of a revision of the durable goods numbers we already got, and they add in non-durable goods numbers. And as you can see, we had a big decline in the prior month. But the question is, do we see a revision upward this month for durable orders? Because in the second quarter, the GDP revision showed that there was a big increase in during the revision in business spending. If business spending is higher, then that's good news for the economy going forward. So we'll keep an eye on that to see what we get from the factory orders durable goods numbers today.
Well, meanwhile, you have the sideshow that often takes center stage of the makeup of the Fed itself and what that's going to look like going forward. Yesterday, the Wall Street Journal had this story that Bessent would start the search for the Fed chair. Curiously, Governor Waller was on media earlier this morning saying that he didn't have a meeting scheduled with him, but maybe it gets scheduled later. What are you looking out for between that and also Myron's confirmation hearing?
Well, this could be, maybe that was Chris Waller's interview.
Maybe, yeah, true.
We know the president watches all these things, and of course his people, the ones at the top of the list here, Warsh and Hassett, have been on TV regularly, so he kind of knows what they're thinking. Also, Michelle Bowman, Philip Jefferson from the Fed, Jim Bullard, we've talked to him about that, and then also Lori Logan from the Dallas Fed, and the others are people who are not connected to the Fed now. Larry Lindsey was on the Fed during the George H.W. Bush years. That's a lot of people. And Bessent seems to be saying, I want a deep bench. I want a lot of people to give to the president in terms of potential names. But the president keeps saying there's only 3 people that he's looking at. We assume the 2 Kevins, and everybody has assumed Waller as sort of the fallback choice. And so do these others really have a chance? That's going to be the interesting question. And, of course, nobody knows because it's Donald Trump, and Donald Trump does what Donald Trump wants.
I just have to wonder, Mike, how much of the recent long-end bond sell-off is coloring all of this, not just the candidate search, but in terms of the data coming in. If you do have weaker data coming and a Fed that wants to cut, but continued pressure on the long end of this yield curve, how does that change with the trajectory of where we're going?
Well, the Fed will argue that they don't control the long end. There's not much they can do about it. Waller today said, you look at 30s, they have moved, 10s have not really moved. So you'd think if the long end was really concerned about something, that both would have moved. And the short end is going to keep moving down because that's the one that's tied to the Fed. So they have to worry about what's going on at the short end, and they can't really be concerned with what's going on at the long end because if it's moving because of deficit concerns, the Fed can't do anything about that. They do have to kind of keep an eye on the 10s because they want to see if inflation is the issue, but they're going to get data on inflation. So they're kind of looking past that at the moment, unless it all leads to some sort of market collapse.
That would certainly need their attention. Well, we're going to get a lot of data this week. Mike, thank you for helping us set it up. Again, JOLTS data coming later, and that is Bloomberg's Michael McKee. A quick check on your future session this morning. As we've been talking about, the bond market sell-off easing, and that's helping to boost stocks. Not small caps, though. Those are still down by a third of 1%. Also helping this morning is Google and Apple shares moving higher. Tech outperforms up 0.7%. The S&P up 0.3%, with your opening bell about 20 minutes away. Coming up, commodity moves are also driving stocks this morning. Traders weighing Fed rate cut bets and reports of an OPEC plus supply hike. We're going to have more on that next as gold continues to trade at record highs. All of that coming up on Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. Campbell's delivering better than expected second quarter earnings driven by Milano cookie sales. Organic snack sales, those though fell 2%, less than half the rate that analysts had predicted. We're also watching Tesla this morning. Sales are continuing to slump across Europe. The Federal Motor Transport Authority saying that new Tesla vehicle registrations dropped 39% in Germany last month. Shares, though, still higher, 1.7%. Meanwhile, gold stocks are in focus after the precious metal hit a fresh new record high, fueled by rate cut bets and growing debt concerns. Gold has risen more than a third this year, making it one of the best performing major commodities. And for more on commodity moves, we're joined now by Simon Casey, Bloomberg's managing editor for energy and commodities in America. So Simon, gold keeps pushing higher than 3,500. There was a time when we said there'd be demand destruction at 2,200, yet here we are. What continues to push it higher?
Well, right now it's the Fed concerns, speculation the Fed will cut, speculation over the concern over the independence of the Fed. As we all know, it's one of the major stories of the last few months. Gold has always been a safe haven historically. We are in interesting times, shall we say. We have concerns about the trade war, concerns about the US economy, the Fed. All those are coming together. Investors are taking a fresh look at gold right now.
I think the gold miner stocks are particularly interesting, too, because initially they were left out of this rally. And presumably for the gold miners to do well, it kind of takes some time to capitalize off of the higher gold prices. The fact that this is a sector up 91% suggests that the run in gold is also longer lasting.
Yeah, I mean, as you say, there's a bit of a lag there, and there's some concern if we go back to the beginning of the year that gold equities weren't really taking off. And historically, gold mining stocks are kind of like a levered play on the gold price. So there is a bit of a time lag, but I think, as you say, now there's real sort of confidence behind gold. If you look at what Goldman Sachs is forecasting for the end of the year, gold could go higher to about 3,700. Maybe next year we could look at $4,000. So there's quite a lot of bullish sentiment out there right now.
Meanwhile, in other commodity moves, there's oil that has been falling this morning. Yeah. OPEC Plus will be meeting on Sunday. What are the expectations? Well,
according to a Reuters report earlier, they're going to discuss another supply increase. And if you remember, throughout this year, OPEC Plus has rather sort of wrong-footed the oil market at times by enthusiastically bringing this production back onto the markets. And while the price has been under pressure as a result, it hasn't collapsed. And that really suggests that they've been fairly successful in regaining market share. And perhaps with that experience in mind, they're taking a fresh look. There's another tranche of production that has been idled during the post-pandemic period, essentially. I think it's around about 1.5 million barrels per day. And if they can try and push that back onto the market over maybe the next year or so, potentially, that's more market share that they're going to reclaim ultimately. But that's bearish for prices in the medium term.
I was going to say, that's the supply side, but does it get much more bearish if you're having that increase, especially as you get later on to this year, next year, if there is a real concern about growth weakening in the world's largest economies?
Yeah, look, throughout the whole of this year, there's been real concern back end of this year. We're now getting close to the fourth quarter. The driving season in the US is officially over. We've just had Labor Day. Meanwhile, in Asia, Chinese demand is very unimpressive. So those concerns haven't gone away. But what we have seen go back to the supply side, US production is close to plateauing. And already in some of the parts of the world, we're seeing production start to respond to the lower levels we've seen this year. So again, there is a plausible case to say OPEC Plus has been fairly successful here in trying to regain market share.
Is OPEC Plus's success at putting more barrels out onto the market and lowering prices also a success for this White House?
That's a good question. I mean, energy dominance, Trump coming in January and proclaiming this is what he wanted to do. Lower oil prices are good. I mean, I think that's his primary concern. He would like to support US oil production. He would like to see that growth continue. It's plateauing, but it's not falling precipitously. But let's bear in mind that US energy dominance, the agenda encompasses everything. It's natural gas, nuclear. Natural gas production is still climbing. Nuclear, there's quite a lot of enthusiasm there. We'll see what the results come through. So it's quite a broad agenda. I think you be careful to sort of say it's a failure just yet.
Fair enough. All right, Simon, thank you so much for joining us this morning. Really appreciate that. Simon Casey, Bloomberg's managing editor for energy and commodities in Americas. And you are seeing energy stocks falling in the pre-market trade, the likes of Exxon, for example, dropping more than 1% off those moves. But elsewhere, it is stability and even gains after 2 days of selling, where worries were abound over big tech and higher bond yields. All of that taking a breather, with bonds not getting past 5% for the long end, and Google coming to save the rest of this market after a decision that does not force them to break off their Chrome. That is a win, and it has tech stocks futures for the NASDAQ up 0.7%. Coming up on the show, Crossmark's Victoria Fernandez talks about AI bubble concerns and warnings about the consumer as we enter the holiday season after we had the likes of Macy's, Dollar Tree reporting earnings. All that coming up. You're watching Bloomberg TV.
Valuation is always in our mind, but at the end of the day, valuation alone is something that doesn't end bull markets. We're not even 3 years into the introduction of ChatGPT, and it is already pervading every aspect of society, every industry, starting to be able to demonstrate how it actually helps business. And to us, that's a recipe for higher stock prices.
Evercore's Julian Emanuel, after raising the firm's S&P 500 price target to 7,750 by the end of 2026, all on the back of AI. Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments, joins us now. Victoria, great to see you. And look, it's not just Julian that is bullish. It is HSBC also raising their target for the S&P 500 today. Steve Chavarone at Federated Hermes saying buy the dips, earning is strong, AI is with us. After yesterday's wobble, to what degree does that very bullish thesis remain intact?
I think it remains intact to an extent because the market really seems to just be looking through a lot of the elements that normally would tell us to be more cautious. So, I mean, we look at valuations, we're at 23 times on the market. Normally that would give you a little bit of pause, but not here. We have tariffs. The market seems to be looking through a lot of the tariff issues that we're going to have and believing that we're going to continue to have strong earnings. And we have. Earnings have surprised to the upside. I think that's one of the biggest reasons we continue to see a tailwind to this market. And every time there's something that we think will maybe have some consolidation, like yesterday, we thought maybe we would get some pullback there. You have some positive news like we saw with Alphabet that really just sent the tech sector back up this morning, supporting all of this. So you do all that, you add in the Fed easing that the market has already priced in and assumes we're going to have. And I think you continue to have these tailwinds to push us higher, at least in the near term. Doesn't mean there won't be volatility, Dani, but I do think the path of least resistance right now is higher.
To your point, Victoria, you get the news coming out that Google doesn't have to spin out Chrome, and it literally lifts the entirety of this market. It's what helped turn things around. Is that in itself, though, not worrisome that you can have these individual stocks? Before it was NVIDIA to the downside earlier this week, but individual stocks continuing to have such a sway in these indices as valuations and weightings increase?
Yeah, I mean, and it's especially true when we look at these names you're talking about. They're all part of that Mag 7, right? Mag 7 was what, 36% of the earnings that we saw. I mean, it's a huge component that we see in this market. And so you have positive news for one, it flows through to the other, like to Apple. Apple had been a laggard for much of this year, and now this is a pop to them as well. So yes, there's a lot of concentration in these names within the market. They tend to drive the market up or down. So positive news with any of them really drives the thesis. We would love to see the rest of the 493 really pick it up and see a broadening. Perhaps we start to see that in the coming quarters. Expectations for earnings are about 40% less for the Mag 7 over the next year than they have been. Maybe that's a chance for the rest of the market to really step up, and that will be beneficial.
Victoria, only a minute here, but there was this Wolf Research note floating around basically saying as long as AI spend continues, this market can be uplifted. But underlying it is this argument that lower free cash flow is a good thing for this market. Are we not throwing aside some of our classical assumptions about stocks for the sake of buying AI-related names?
You're exactly right. Free cash flow, take out NVIDIA from the Mag 7, was down 16% year over year in the second quarter because of exactly what you're saying, that higher spend. I do think it's a concern we have to watch and make sure that that balance sheet stays strong. It's the main thing that you look at when picking a stock. So yes, we want to see them invest, but we want to see that free cash flow stay high as well. That's what the ROI is on AI, and we're not really getting a clear picture on that yet.
So well said, Victoria. Stick around with us. Much more to discuss. Victoria Fernandez there of Crossmark. A quick check on futures as we are just moments away from that opening bell, and it does look like 2 days of declines are set to reverse, higher by 0.4% for the S&P, 0.7 for the Nasdaq. As Victoria was just saying, it is the Google tide that is lifting all boats this morning as small caps continue to lag, down by 0.25%, with the long end of the yield curve bouncing around 5%, maybe still pressuring the small cap equities. All right, coming up next on Open Interest, it is your opening bell. This is Bloomberg. Moments away from the start of trading, you are watching Bloomberg Open Interest. I'm Dani Berger, and it looks like we're going to rebound after 2 days of losses led by big tech. Thank you, Google, and the decision there not to have to spin off Chrome, up 0.6, and the S&P also rises off the back of that. Your small caps still seeming to suffer in today's session. We have the opening bell now ringing, it looks like, over at the New York Stock Exchange. We have Pulte Group, which, by the way, was founded by Bill Pulte, the Federal Housing Agency Director's grandfather. He's, of course, not currently part of this company. It looks like you also have Lynn Martin there, the president of the New York Stock Exchange, helping to ring the bell. And over at the NASDAQ, you have eBay ringing the bell. 30 years of eBay. They went public 3 years after that. And they will be on the close today, 4:30 p.m. So definitely one to keep an eye on. All right, we do have some stocks that we're keeping an eye on here at the open. Macy's off to the races, easily one of the best performing stocks, it would seem to be this morning, up 14.6%. They raised their annual outlook, reported its best comparable sales growth in 12 quarters. Dollar Tree also raised its outlook for the year. More consumers looking for lower priced goods, but the current quarter wasn't as strong. And that has investors concerned about the sustainability of growth. And I mentioned this at the top. This is the thing basically lifting the entirety of the equity market this morning. It is Alphabet shares up 7.2%. Google will not have to sell its Chrome browser as part of an antitrust ruling. Analysts see that as favorable for big tech. Dan Ives saying that like a cheap suit that the government has folded. So there you go. Stocks are higher on the morning at the opening bell, and we are back with Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. And Victoria, maybe it's also notable that we're moving higher this morning, despite the fact we've had 30-year yields bumping up around 5%. What is the transmission? When do you get worried about those higher yields continuing to weigh on this equity market?
Yeah, I think typically the equity market does watch that 5% mark when we get close to that. But what we've been seeing is as yields go up and they hit some of those levels that previously has caused some concern, we've actually seen people step in and start buying, locking in some of those higher rates on the fixed income side of their portfolios. And then that brings yields back down a little bit. Now, some of the pressure we're seeing is from global Bond yields, obviously, we've seen when you look at Japan, 30 years at all-time highs, 20 years at 2-decade highs. We're seeing it in France as well and in Germany. So we're getting some pressure globally on the yield side, which doesn't make the equity market as nervous. But I do think they're going to be paying attention if we go over that 5% level and we get a Fed that maybe is not as dovish as people are anticipating based on what we get on the labor market reports this week, then I think you could see some nervousness possibly in the equity market.
I just wonder what it means for the broadening out that we were talking about, Victoria, that you hope that you will see as the year goes on, especially for companies like small caps that have a lot of floating debt that are more sustainable or more susceptible, rather, to higher borrowing costs. Does that really challenge some of the rotation thesis?
It does, in the sense that small caps need to have those lower rates like you're talking about. And a lot of their debt is coming due from COVID, where they went ahead, they had those lower yields, they bought that debt. A lot of that is maturing at this point, and they're having to reinvest. So they need those yields to come down in order to continue to do well. Now, I will say in the short term, the small cap trend has actually moved up a little bit. It's positive relative to the Russell 1000. So that's good news. It doesn't mean it's sustainable at this point in time. They do need to see rates come down to continue to see that happen, and they need their earnings to improve. We talked about earnings earlier as something that's been a tailwind for this market. Small cap earnings have not risen to the level that we've seen in the larger cap stocks. And so once that starts to happen, then I think you have more of a solid foundation there and you'd see more of a rotation. We just haven't seen it yet.
Victoria, when it comes to earnings, the Wall Street Journal had this really interesting story out this morning, basically saying, yes, companies are beating expectations. But if you look through why they've beat, it comes from managers that have been cutting costs, boosting productivity, some of the uses of new technology. How sustainable are earnings beats if they're not driven by necessarily fundamental growth, but rather cost cuts to preserve margins?
I mean, Dani, you can only cut costs so much, right? At some point, that is no longer an option in order to help your balance sheet look better and in order to get those earnings numbers that you're striving for. So there is a limited amount of time that can be beneficial. What we have seen as well is, even though there haven't been mass layoffs, we have seen quite a few companies across many different industries start to lay off and reduce some expenses there. I mean, whether it's a Kroger or a Paramount, Procter & Gamble, Nike, even Alphabet. So we've seen some of these companies be able to reduce some of those costs. At some point, we have to see the revenues start to go higher. And there's going to be some concern around that, especially as we look at the consumer and we see the consumer weakening. It's all tied back to the labor market. And if labor market can stay steady, then the consumer, especially here in the U.S., will continue to spend. That should hold up earnings. But it is questionable right now as to how strong that can be going forward.
Well, we're going to get more clues on that labor market starting 10 a.m. today. JOLTS data ending the week with jobs, unemployment claims. Victoria, thank you so much for joining us this morning. Crossmark Global Investment Chief Market Strategist, Victoria Fernandez. All right, let's check in on where stocks stand at the moment. Just 5 minutes into your trading session. We're higher on the session, but as you can see there, it's actually not the best of breath. More stocks are down than are up. Nearly 300 stocks are down, 200 are up. But what is supporting us? It is the colossal Mag 7 that seems to be doing very well. It is Apple and Alphabet after that antitrust ruling that allows Google to keep Chrome, that allows them to keep paying Apple. That is what's supporting us this morning. And we have had tech in the recent 2 days also weighing on the sell. So a little bit of a turnaround. NVIDIA, I should say, still down in today's session, just 0.5%, but because of its weighting, it is one of the biggest decliners on that. Berkshire Hathaway, Boeing also falling in today's session. Meanwhile, if you look at the sectors that are on the move, again, you get this flavor that even though we are higher, it is not on good breath. It is the comms sector, which again includes companies like Google and Infotech, which includes companies like Apple, that is helping to lift us up. 2.8% is the gain there. I just want to point out the bottom, you'll see energy stocks here. Those are falling as the price of oil also falls, with OPEC plus a Reuters report saying that they're going to look at lifting production. So that's why you see some of those changes there. But again, tech dominating in today's session, allowing for gains. And Google has responded to that antitrust ruling that I mentioned. They've been saying we have concerns about how these requirements will impact users and their privacy, and we're reviewing the decision closely. Bloomberg Tech co-host Ed Ledlow joins us now. So, Ed, the market celebrates. How much is Alphabet celebrating off the back of this decision?
Yeah, Alphabet internally will be celebrating the main point, which is that the court did not require a breakup and did not require Google to divest Chrome or any other Android platform property. That is the main headline. Alphabet, following the open, has settled up 7%, on track for its biggest gain since April. There is still the matter of what the judge in the case does require Google to do. And as you quite rightly point out, the main response from Google, the thing that they may even appeal, is the idea that they'll have to share search data with rivals. And when we think about rivals, DuckDuckGo, Perplexity, even OpenAI, their main argument being that there is a privacy risk. The street looking well past that, the Chrome browser being the mainstay of it. But the main second thing in the affirmative that Google's still able to do is to pay Apple around $20 billion a year to be the default search placement. They cannot have exclusive contracts that restricts distribution, but they can pay for the right to do so. So Apple's up 7%, Alphabet, is up 7%, but Apple is up also markedly as well.
Ed, can we just talk about the irony of the situation where you literally have OpenAI's rise being the thing that has saved Google from breaking up?
Yeah. The judge in the case was absolutely explicit. The thing that changed the course of events that yielded this result was the rise of generative AI. And the judge specifically noting that that has created competition. But at the end of the day, this was about search. And so, the only thing that the market's paying attention to, and there's the history of several bids for Chrome from some of the AI names like Perplexity, was the idea that Chrome did not need to be divested, but data does need to be shared with rivals in the search domain. And what happens next? The judge has invited all parties, the government and Alphabet, to return September 10th with codified proposals on the remedy in line with the judge's ruling. But I don't know that that's the end of the story, Dani.
Yeah, well, we look forward to you continuing to cover the story as it unfolds, and looking forward to seeing you in 1.5 hours' time on Bloomberg Tech. That is Bloomberg's Ed Ludlow. Coming up on this show, Macy's soaring, raising its annual outlook, but still warns of a more cautious consumer. We're going to take a look at the retailer. That's coming up next. You're watching Bloomberg Open Interest. Let's get you some top calls now. Some of the analyst action in focus this morning. First up, Morgan Stanley upgrades Kraft Heinz to equal weight, saying the stock's valuation now looks more reasonable ahead of its upcoming split, varying with Warren Buffett, who, by the way, yesterday said he did not think the split would help them. Next up, Bank of America downgrading Phillips 66 to neutral, seeing a challenging outlook for chemicals and natural gas. Those shares little change, though. Then you have Argus upgrading Wynn Resorts to a buy, highlighting a significant recovery in Macau and the potential for market share gain in Las Vegas. Let's turn, though, back to one of our top stories this morning with the retailers reporting earnings. Look at that huge gain in Macy's, up 20.5%. It raised its annual outlook. It reported its best comparable sales growth in 3 years, attracting all types of customers. The company's CEO telling Bloomberg's Romain Bostic that they have content for both for both big spenders and savers. I'm pleased to say that fresh off of speaking with the company's CEO, Romain joins me now around the desk. Romain, really great interview you had with the Macy's CEO here for Bloomberg News. How does this mean their turnaround is? Is it on track? Is it complete with this type of earnings?
Well, it's certainly not complete, but I think by the sheer reaction, I think investors are growing a little bit more confident. Remember, Tony Spring just took over as CEO back in February of 2024, so it hasn't even been a full 2 years. There are a lot of doubts about his ability to turn around what is essentially a big legacy business, particularly with the Macy's brand itself. Remember, Bloomingdale's is also under this. They've been doing well for a while. Tony actually used to help run that company, that side of the company. Blue Mercury, another component of this business, also doing well. But we know Macy's as Macy's, and that's been struggling. And what he's done is shut down a lot of stores. He's taken about 125 other Macy's stores, completely revamped them, tried to make the shopping experience better, make them more aesthetic, create more experiential things in them. And at least for right now, it does appear to be paying off. You're seeing that in comp sales growth. It was a big surprise this quarter. Most people were expecting a flat quarter, even a down quarter. They came in at about 1.9%. If you just X out all of the businesses that they're closing, that's good. Now, this is still a company that's in decline. It's just that decline is now slowing.
Well, trying to do a turnaround in best of times is hard, and it's certainly not the best of times. You have retailers like Macy's having to contend with changing consumer appetite and especially tariffs. What is their strategy going forward to try to make sure that they can maintain margin with some of the higher prices maybe weighing on them?
Well, they did provide some insights, the idea that they're getting about a 40 to 60 basis point hit on margin, specifically from the tariffs. While he did say that they did raise prices in some areas, he did say they're still holding price in others, though he did indicate that that could change. I think one interesting thing that he talked about was the ability for Macy's to negotiate with the suppliers. Remember, this is a behemoth of a retailer, so they do have some flexibility. They also have private label brands. These are things they make themselves. The tariff costs are much more impactful there. They said they're doing their best there to also reduce that cost. And you saw that in the most recent quarter. Expenses were lower, inventory was lower, and you saw a better product mix that actually helped to boost sales in particular categories like women's apparel, which they have been lagging in.
What does all of this say then just generally about the consumer at this moment and their willingness to spend and maybe eat some of the price increases?
Well, he talked a lot in my interview about the consumer being more surgical, more choiceful. This also came up on the conference call, the idea that people are sort of making choices about what to spend. But in the quote that you used, that was a key quote that he used when I spoke to him in the interview. This idea that they offer something for everybody. They offer something for the higher end consumer and something for the lower end consumer. And he thinks that that could be the strength of Macy's. And maybe that's where they are. Because remember, this has been a story about identity. I mean, what is Macy's? What is a department store, particularly in this environment? He seems to think he's found a way, and at least for today, with that 20% pop in the shares, investors seem to be somewhat pleased.
Yeah, maybe a clear kind of market share grab he's trying to undergo. Romain, thank you so much for bringing us that interview. That is Bloomberg's Romain Bostic, and we're going to continue the retail conversation. Lisa Abramovitz will be speaking with Gap CEO Richard Dixon in about 24 hours' time, so don't miss that conversation tomorrow. Now, coming up, Figma posts results today after a record-breaking IPO. We'll preview what to expect and what it means for this IPO market. All of that coming up next. You're watching Bloomberg Open Interest. Minutes into your trading day. You're watching Bloomberg Open Interest, a check on these markets as we head further into the session, and it's green for the first time in 2 days. Being led by tech, the NASDAQ outperforms up 0.6% to the S&P's 1/3. So if you look at that tech that is leading us there, it's also helped by bond yields. Look at what they're doing. They're actually falling now. They were moving higher this morning. At one point, that 30-year yield was just 1 basis point away from 5%. Again, we back off of that and give in to gains. So if you look at what the tech names themselves are doing, Alphabet shares, they're up 8% again after that ruling that they don't have to spin off Chrome, that they can continue to pay Apple for using Chrome. So Apple shares up 2.6%. Nvidia just now flipping into the green. It was negative to start the session. So all of the Mag 7 more or less having a pretty good day, as is Macy's. Again, we're just talking to Romain Bostic about this. Look at that gain, 20%, having its best quarter in 3 years as they try to engineer that turnaround and as it picks up steam. Dollar Tree stores, though, to the downside, a lackluster guide for the current quarter, having concerns about that lower income consumer and some of the exposure to tariffs. Now, let's now turn to one of the other highly anticipated earnings and the most anticipated public debut of this year. The software company Figma will post results after the bell. This is its first set of results since its blockbuster IPO, which happened just 4 months ago. Shares are up 1% ahead of those earnings. For more, we're joined by Bloomberg's Bailey Lipschultz, who follows IPOs for us. So, Bailey, after a breakneck run for Figma shares, what are the expectations for earnings?
No one really knows, Dani. And this is a company, it's still essentially doubled from its IPO price, though it was down about 40%, call it, from that debut close. We've seen analysts baking in or talking up expectations for growth next year to slow down to about 20%. This coming after the company itself had predicted this year they would grow 30 to 35%. The big thing, though, Dani, is when you're a company that's newly public and you're reporting for the first time, you have to beat expectations and you have to raise expectations. These are management teams that meet with analysts before going public. You kind of talk talk down your first earnings report. If you miss, you're in the penalty box. So it's going to be closely watched print. But again, the big thing is it's essentially doubled. And so when you look at Wall Street, 7 hold recommendations, 3 buys, no sells. Not really a strong reception from the sell side.
Yeah, it's the hard part. Now you have to prove your valuation. But how much of this is not just proving Figma and their company's sustainability at the current valuations, but also just all these pricey stocks that we're getting to IPO? How big of a test is it for that in general?
Well, it'll be key. And this is a company, again, one of the few companies this year and really over the last few years in the software space to go public. You're pitching an AI story and how their technology can continue to actually fend off concerns around AI really eating the lunch of most software companies. But the big thing is, when you see these big rallies, we saw Circle up 3, 4, 5 times and still holding on to those gains after some early investors were able to sell. With Figma, what are real long-term investors looking for? If we do see steady weakness, will we see some of those IPO buyers step up in size, or is it still a bit rich from a valuation perspective?
Can we just talk about also how important this period in particular is for this IPO market? Because you had a first half where everybody was saying IPOs are coming back. You've covered a lot of them. They've really been confined to maybe more crypto and high-flying tech type names. You have Gemini, you have Klarna heading off on their road shows. Is this the period to really gauge whether the IPO market is truly coming back in force?
Without a doubt. And this is going to be a week next week where we'll see likely the largest volume since ARM went public, but more kind of important is that this is the first real test since 2021 where we've seen 6 or 7 companies going to be on the road at the same time. You have a range of companies, as you mentioned, Klarna, Via launching their process today. You have some insurance companies on the road. So kind of a broad group of companies courting first-time IPO buyers. It hasn't been like this really, again, since 2021. So it'll be interesting how they price, how they trade in the aftermarket, and if we're going to see, when we see 3 or 4 deals pricing in one day, how we can see investors kind of dividing their attention.
I was going to say, after looking at kind of the success of Figma, as you say, doubling and Circle and that sort of thing, how are these companies thinking about their pricing strategies for IPOs?
We've seen a lot go back to kind of the bread and butter, where you start out with a lower valuation, you start out with a smaller number on that cover when you launch your process. You get some strong feedback when you're on the road. Then we see companies refile to either increase the number of shares or ramp up the actual price for the first-time share sale, and then ultimately, in a perfect scenario, pricing above that. We saw that play out with the last handful. It's going to be interesting to see if this is a strategy that Gemini implements. We saw Klarna, again, looking to raise more than $1.2 billion. That's a pretty big amount of money for that company to raise, so it's going to be interesting to see how they navigate that.
Some more tests, and again, we get one of them in the form of Figma earnings after the bell today. Bailey, thank you so much for helping set it up for us. That is Bloomberg's Bailey Lipschultz. All right, about 25 minutes into your trading day, and now we have all the major indices in the green. You'll recall the Russell 2000 started out in the red. Helping us is the fact that we're actually seeing bond yields start to decline. In the U.S. session, we flipped from losses to gains as we are buying. That's helping to lift up all equities this morning. 0.5% is the gain for the NASDAQ. Again, it is the Google of the world, the Alphabet, the Apples, rather, helping lift up the entirety of this session, considering having that antitrust ruling that finds that they do not have to spin off Google Chrome. Well, coming up in the next hour, BlackRock strategist Gargi Chaudhuri says that she sees investor sentiment has remained robust despite some of that ongoing uncertainty. Plus, Empower CEO on alternative assets coming to 401ks. And we talk about the state of the consumer as retailers like Macy's warn of a potential pullback this holiday season, and Dollar Tree shares sink on a disappointing guide for the current quarter. All of that coming up on the next hour of Bloomberg Open Interest. Minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Berger. Matt Miller is on assignment. It is a market that is rallying after 2 days of losses, thanks to the fact that bond yields moving lower in the session so far, not having that fear of higher yields. And at the same time, you are also getting help from Google, help from Alphabet, the fact that you had a court ruling that said that they did not have to spin off Chrome. It is a big week of data, though. Jobs data coming in, jolts among them breaking now across the terminal. Let's get to Bloomberg's Michael McKee. Mike, what's the data showing us?
Well, the JOLTS numbers come in a little bit lower than anticipated, which I suppose is good news in a way. It suggests maybe the unemployment rate isn't going to move as much. 7,181,000 jobs openings. Now, this is for the month of July, not for the month of August. Friday, we get the August payrolls report. Last month, which would have been June for JOLTS, 7,437,000. So we have seen a decline, but it's still a fairly strong rate. This was about where we were, maybe a little higher than where we were before the COVID sort of upset the apple cart with JOLTS. The quits level stays the same, 2%. So no worries for the Fed there one way or another. Layoffs level, the layoff rate rises a little bit to 1.1%, but that's not much of a change from the 1% previously. Factory orders, the other number that is out, down only 1.3%. The initial report was down 4.8%. Durable goods orders down 2.8%, same as we saw in the initial durables report, but ex-transport, which of course leaves out cars and airplanes, up 1%. That's a little bit less than the 1.1%. So business spending still hanging in there, not as strong as it might otherwise have been.
And just some of that data seeming to help the rally in bond markets pick up steam. It is a 10-year yield that's now down by 3 basis points. Mike, it's a lot to keep track of this morning. It's not just the eco data. We've also had some Fed speak. What have we heard?
We've got 3 Fed officials speaking today, 2 presidents and a governor. The presidents, Alberto Musalem and Rafael Bostic, are basically saying the same thing, that risks to both unemployment and inflation have moved more into balance, and that leaves open the question of what they might do in September. Both of them had been on the relatively hawkish side, with Musalem saying he wasn't ready to cut rates at all before, and Bostic saying December. Now, Bostic says he's open at any time if we see a weakening in the labor market that would cause the Fed to move. And we also heard from Musalem that he is going to be looking at the labor market data very closely to see how it compares with the inflation data. He's still a bit concerned that inflation's going to run hot. And then Chris Waller was speaking this morning, the Fed governor, and he basically repeated what he has been saying, that yes, we should cut rates in September. He, of course, with Mickey Bowman, the dissenters in July. And he said that he thinks that perhaps we need to have several rate cuts in a row, because he wants to see the economy get back to a neutral rate, because he thinks the economy is slowing faster, and as he has said, inflation will go up because of tariffs, but it won't be lasting.
Well, we'll have more jobs data throughout the week. Mike, thank you very much for that. That is Bloomberg's Michael McKee. I'm also pleased to say that Gargi Chaudhuri, BlackRock Chief Investment and Portfolio Strategist for the Americas, joins us now. Gargi, great to see you this morning.
Great to be here.
So we have a little bit of jobs data showing that job openings are the lowest in July for about 10 months. So maybe some more of that tension in labor market about things weakening. At the moment, bond yields turn to declines. Equities continue to have gains. How much volatility could we see as the job data comes in through this week? Just how big of a risk event is it for this market?
First of all, congratulations on the show.
Well,
Very excited to be here.
Great to have you on the first week I'm here.
Absolutely. So a couple of things. You know, we just published our fall outlook, fall investment directions. And one of the things that we are talking about in that is this expectation that given the deceleration in non-farm payrolls that we've seen, given inflation certainly not back at target, but certain components of inflation coming back down closer to target, especially when you look at some of those rental and housing components. The expectation is that the Fed is going to move this September and cut rates by 25 basis points. So for this Friday's data, I mean, of course, it's important. All labor market data is important. But for the Fed to not go or to go more than 25, it would have to be a very strong or a very weak data. And more than that, I think what many investors are looking at is not just whether we get sort of a 75 or 80 or 100K. It's around the unemployment that is expected to move up to 4.3. We almost got this, but this time it's expected to round up. If we get a 4.4, what does that mean for the markets? And then immediately looking ahead, what we'll focus on is the revisions, the annual revisions, that numbers that come out on Tuesday of next week.
I think the White House is also focused on the annual revisions, Gargi. We'll put that aside for now because that's another whole can of worms. For this market, at what point do we cross the threshold where bad news is no longer good news for equities? Because we have seen them rally alongside the idea that we're going to get cuts. At what point do you really get some growth scares that come back into this market and maybe hamper the the ability of risk assets to continue to flow along?
Two things to note here. So the first one is around growth scare. If anything, it's actually, when we look at the revisions to the second quarter GDP, and particularly where they come from, the AI CapEx actually making its way into that IPP, the intellectual property product measurement, that's really big news. I think that's even more exciting news than NVIDIA's earnings, for example. So that's number one. We are expecting the second half GDP to be a little bit better than what it was estimated to be coming into this year. So that's, not really seeing a meaningful slowdown. Yes, the labor market certainly can be a concern, but then again, is it more of a moderation, or are we seeing negative job prints? I think that's what people are going to look at. The second point I want to make is around the seasonality. So clearly, we all know, everyone listening to this show knows that September and a little part of October tends to be seasonally weak for equity markets as well as for bond markets. Some of that self-fulfilling prophecy, we already saw that. Let's hope it doesn't happen. Let's hope fundamentals drive the day. But we have to acknowledge a pattern that we've seen over the last 10 years and whether that plays out, especially at a time when we've seen this tremendous rally from the April lows to now. This is why we're telling investors, continue to focus on large cap and growth areas of the market. Continue to be really nimble in your factor management and really looking at dynamic factor rotation strategies to be able to move to momentum or to move to value when the time is appropriate.
That is interesting because there were a couple times last month where you had some serious momentum crashes. Maybe crashes is a bit of an exaggeration, but you had momentum really having a rough go of it with no necessary catalyst. Does that continue just because of how highly valued some of these stocks are? Do you see things like momentum continuing to get challenged through the month of September?
So I think it's not about just highly valued those companies are. I think we also have to take a step back and think about how strong their earnings growth are. Yes, the valuations can optically look to be trading at a significant premium to perhaps their 5-year or their 10-year levels, but look at where the earnings growth and the projected earnings growth are. And I think when we look at the tech sector in particular, and we see the revisions for Q3 and Q4, and we see the earnings growth at over 20% in Q2, much higher than expected and much higher than the rest of the other S&P sectors, I think that's what the driver is. So can we have pullbacks? Sure we can. And will investors sell what they own? Maybe. But I imagine that if we do get that and the earnings dynamic remains strong, that provides an incredible opportunity for investors to continue to allocate to risk assets, which is what we've seen so far this year.
But Gargi, I'm hearing you advocate for that to be in the large cap tech. Are you less optimistic then for any sort of rotation, maybe to some more of the unloved parts of this market right now?
So we're focusing on growth and large cap tech with an eye on looking at specifically the AI story. So really focusing on the BlackRock AI and Tech Fund that actually looks at AI along the capital stack. But that's not it. We're also talking about sectors like financials, which we think tend to do well in periods where we can continue to have a yield curve steepening. The one area that we're cautious of, especially after the August rally, continues to be small caps. And this is an unloved area of the market, but at the same time has underperformed meaningfully over the course of the last 3 years, right, when compared to large caps. So a lot of investors may look at valuations and think this is the time to step in, especially if the Fed is sort of poised to cut rates in September. And this is where we'd still say that rallies are most likely to be unsustained for larger periods of time. We think that for small caps to continue to rally, you need to see an economic acceleration as well as a rate cutting cycle to be much, much deeper than what we expect this one to be. So that's the area that we tell investors to be cautious, as well as one other plug that I would make is for the very long end of the fixed income markets. Fixed income, extremely attractive, but in the belly of the curve. So really focusing on that 3 to 7 year sector.
30-year yield, I mean, it's had a rough go of it. Granted, yields are down 5 basis points this morning. Is there a level at which you would say, all right, it's gone too far, it becomes attractive? Or does the volatility of inflation, make the long end just continually punished?
I think it's not just a level, it's level in coordination with what else is happening in the market at that time. So if interest rates continue to rise along the yield curve and the yield curve steepens and we've priced in a lot of term premium, which still isn't the case, while at the same time, there's a serious growth scare. absolutely, that is when you want to step out into the 10-year, perhaps even longer. But so it's not just about the level, it is about the economic dynamics behind what's driving markets. We're not there yet. We're not necessarily seeing that growth slow down. We're not necessarily able to pick up a lot more yield and carry in the belly of the curve. So you don't necessarily need to take that duration in the very long end.
Gargi, so wonderful to see you this morning.
Wonderful.
Thank you so much for stopping by. Fantastic as always. That is Gargi Chaudhuri, BlackRock Chief Investment and Portfolio Strategist for the Americas. Coming up on the show, Apple climbs alongside Alphabet as an antitrust ruling keeps their search engine agreement intact. We're going to have Mark Gurman joining us for that latest. Coming up next, this is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. Macy is reporting its best comparable sales growth in 3 years and boosted its annual outlook. All of that, despite the strong results, the company still warned of a more cautious consumer in the second half of the year. Shares up 19%. Also watching Tesla this morning, sales continuing to slump across Europe. The Federal Motor Transport Authority saying that new Tesla vehicle registrations dropped 39% in Germany last month. Meanwhile, Google shares are rising. A judge ruled that the search giant wouldn't be forced to sell its Chrome business in a landmark antitrust case. Google will, however, be required to share data online with search rivals. Apple shares also climbing after the ruling stopped short of axing its search arrangement with Google. Joining us for more on this is Bloomberg's Mark Gurman, who covers all things Apple and consumer tech for us. Mark, just how big of a win is this, not just for Google, but for Apple?
It's even bigger than that. It's a gigantic win for the technology industry at large. As you know, regulators in the US and abroad, they're all going after everyone, right? Apple's at the center of things, Google's at the center of things, Meta is at the center of things. And so now this judge yesterday set the precedent that he's not breaking up these companies, right? And so Google, they're going to be able to continue operating Chrome. They're going to continue being able to reach these default search arrangements with Apple and others. Things are going to continue. So this is not only good for Apple and Google, but the whole industry at large.
It is pretty wild, though, Mark, to see that the judge ruling this, saying that literally Alphabet's biggest competitor, that is AI, being the reason that he came to this conclusion that there's competition there. Can that be the takeaway of this, too? That, yes, they can keep Chrome, but they have some serious, serious competition.
It's so fascinating. During the trial, Google brought in Eddie Q, who's the head of services at Apple, the person who engineered this $20 billion a year search agreement between the two companies. And his whole speech there in court, his whole testimony was that Google search doesn't matter. We've moved on to artificial intelligence-based search. So why would you break up a deal if it doesn't matter and is going to get blown up by the emergence of tech anyways, right? And that's what seemed to have sold the judge, right? It was Q's testimony. And so it worked out, and the company now was saved over $20 billion a year, and Google is going to continue making so much more. Apple's making $20 billion a year on this deal. Google's making 3-4x that, because remember, the $20 billion is a 30% slice. And this is about more eyeballs on Google search. And you're going to see this evolve into AI anyway. So it worked out for Apple and Google.
What does the data sharing portion of this mean, especially with things like Gemini, as they have other competitors? Does this give their AI competitors an advantage that they can use more of Google's data?
Potentially. This is something when Google responded to the lawsuit outcome yesterday, they were very excited, but it's not all sunshine and rainbows for them. They don't want to have to give up this data, which they consider very proprietary, and they consider giving it up a privacy issue. But I think Google should just take the W here and kind of move on.
Take the W and move on, but maybe not. I mean, a judge did say that things could change when it comes to that revenue sharing with Apple. And you mentioned it's not just the U.S., it's internationally that they're facing scrutiny too. What are sort of the big hanging unknowns that remain for them?
Well, it's the European Union, specifically for Apple. The EU wants to break up the App Store. That's another $20 billion a year business in terms of gross profit. And that's a business that you're going to see continue to get upended, not only in the EU, but in the US too. A judge ruled earlier this year that Apple is not allowed to stop developers from telling customers that they can subscribe to services outside the App Store, which means Apple doesn't get that percentage. Same thing's happening to Google here and abroad. happening actually in many parts of the world, South America, some countries there talking about it, some countries in Asia talking about it, Australia is certainly involved. So you're going to see the landscape, the technology landscape, really begin to shift in terms of these business practices. But for now, huge win for both Apple, Google, and the rest of the industry in the US.
Apple maybe need it, Mark, because I feel like every day, if I look at the stories you've written, it's usually something like top Apple so-and-so researcher leaves for so-and-so competitor, usually Meta. You wrote about this yesterday, that it was someone from their robotics team, an AI researcher there. Who's left at Apple at this point?
So over 10% of Apple's large language models team, that's the team of academics and researchers, many of them coming from China, who are developing the core technology for generative AI for Apple Intelligence and Siri. A lot of them have gone to Meta, some now are going to Anthropic, some are going to OpenAI. There's a few factors at play here. Obviously, the morale on the team is not great. The Apple Intelligence response from consumers and Siri, they've seen delays there, has been very muted. People are not pleased with it. People are not using it as much as they're using other AI services, at least in some cases. They are looking at third-party solutions. They've talked to Google about using Gemini. They've talked to Anthropic about using Claude. They've talked to OpenAI about using ChatGPT. And that sort of sinks the morale in the team developing the in-house technology. We're developing in-house technology, but Apple's looking to replace us with third parties. That doesn't feel really good. But I think the biggest thing here is that money talks. Meta hired Roman Pang for a pay package worth well over $200 million over several years 2 months ago. He created Apple's LLM team. He ran the LLM team. And several people from Apple have now followed him to Meta and have gone to the other companies I mentioned
Mark,
as well.
These pay packages are just so astronomical. It's basically like pro athlete level type pay packages. Is it paying off? Are you seeing the dividends yet, or is it too early to say for all of the hires they've done?
I think it's very too early to tell, but this is not, if you're Meta, this is really not how you build a company. Let's stick to the sports analogy. You see super teams in the NBA. I mean, if you remember the Miami Heatles, when LeBron, Dwayne Wade, and Chris Bosh all teamed up, they just threw a bunch of money at that, brought a bunch of superstars together, and it didn't work out. Right? Who can forget the Kobe Bryant, Dwight Howard Lakers in 2012? That didn't work out. So sometimes throwing money at the problem and bringing a bunch of superstars together with clashing personalities doesn't work immediately or ever work. And we're beginning to hear murmurs of that happening at Meta too. A bunch of high-powered, highly paid people with different opinions and different personalities. It's going to generally clash no matter what industry you're in. So Meta needs some luck here for it to work out too.
Mark, thank you so much for joining. Really great stuff. Love that analogy. You can be the Saudis buying up every single football player, and maybe no one's still watching that league. Anyway, still ahead on the show, Jane Street pulling in a record $10.1 billion in second quarter trading revenue. We're going to discuss that next. This is Bloomberg. Jane Street pulled in a record $10.1 billion of trading revenue in the second quarter, beating out all of Wall Street's biggest banks. Hudson River Trading and Citadel Securities also reporting a strong first half of the year. Bloomberg finance reporter Catherine Doherty joins us more for this story. Catherine, let's just start with the why. How were they able to pull in such a big windfall?
So just like the big banks, trading has been up year over year. Ever since the Trump administration came in, we've seen record volumes. There's a ton of volatility, and the banks that are handling trading and these non-bank liquidity providers, these trading firms like Jane Street, like Citadel Securities, they're benefiting from this volatility. They're the ones that are standing in the middle, helping facilitate buying and selling across asset classes. And this is not just in the US, but globally. We've just seen record volumes. So the numbers that these non-bank liquidity providers, the Jane Streets of the world, they have put out recently, they are able to take, in Jane Street's situation, very big bets. They're putting up a lot of money in order to really facilitate the trading on behalf of clients, step in the middle of trades, and what they're able to produce, we're seeing $10 billion in a 3-month period. That is 1 quarter. That has surpassed JP Morgan for the first time. So it's really, in many ways, a shift of who the big players are in the trading landscape. It's not just the core 3 Wall Street banks that we normally will talk about in this space.
What is causing that shift, and just how big of a threat is it that you can have JP Morgan, the biggest bank, fall behind on trading to some of these non-banking entities?
So this has been a gradual shift over time. Really, you can go back to the financial crisis. The banks are under regulatory scrutiny. They have to hold capital. Their own balance sheet is restricted. Firms like Jane Street, Citadel Securities, they have their own capital that is not under the same regulatory scrutiny. So that is one core difference. The other difference being the banks, they're investing in their people, they're investing in technology, they want to keep up. But these Jane Streets and Citadel Securities, the Hudson River Tradings of the world, they can invest more so because, again, they're not restricted by the amount of capital that they're not only putting to work in trading, but they're able to invest and develop their algorithms, and also poach to get the best people to develop that technology behind the scenes.
It's always so much about talent, too. Catherine, thank you so much for bringing us this story. Excellent reporting. That is Bloomberg finance reporter Catherine Doherty. Coming up on the show, Empower plans to add private market investments to retirement plans. They have partnered with Apollo and others to bring that into the accounts. We're going to be speaking to Ed Murphy. That is the company's CEO. That's coming up next, a conversation you don't want to miss on Bloomberg Open Interest.
In the context of a retirement plan, typically these are longer dated investment plans. Illiquidity is one of the gating factors for broader acceptance of private market investments.
I think right now there are a lot of limitations. Right now, a lot of people, you go work for a company, you have someone who makes a decision as to what's available to you. The ERISA rules have to be changed to make it possible.
That was Atomic Invest CEO David Dindy and the CEO of ICI, Eric Pan, discussing President Trump's plan to open 401ks to alternative assets. Empower, the second largest retirement services provider in the U.S., plans to offer private market investments in retirement plans as well. Joining us now, I am pleased to say, is Ed Murphy, Empower CEO and President. Ed, great to see you. Thanks for coming into the studio.
Good to be here.
So you have this executive order from President Trump that really excited a lot of players in this. What is the process like now to actually getting those private assets into 401ks?
Well, it's a good question. So, we launched this initiative back in May, and then subsequent to that, the executive order from the Trump administration came out, basically directing the DOL to issue guidelines, and we expect that they will issue guidelines at the suggested deadline, which is February 3rd of next year. The DOL, I'm told, has been working on this for a while, so we're confident they'll not only hit the deadline, but I think they'll give robust guidance to plan sponsors, which I think is going to be important to drive adoption and acceptance in the market.
There's also this big question of who are the players that drive this adoption. I know you've partnered with a couple people to get this done, Apollo, Goldman, PIMCO, Partners Groups, among those.
Yes.
When you assess who it makes sense with to partner for to get these kind of assets, who do you figure out are the appropriate players? How do we judge who the winners are? Is it size? Is it quality? Is it something else?
Well, I think it's all the above. It's performance. It's the track record they have over a period of time. But at the end of the day, Empower's goal is just to give access to the 19 million Americans that we work with today. And in doing so, we're going to open up the universe to all the qualified parties. Right now, we've started off with 7 or 8 providers that we're working closely with. And I think if you look at the track record of private equity, just take the last 25 years from 2000 to present date, the average return net of fees is around 13%. If you compare that with the Russell 3000, it's about 8%. So you have 500 basis points of outperformance on a compounded annual basis. You're talking about a significant increase in asset values for Americans in these retirement plans where they're likely to invest for 25, 30 years. And the biggest challenge that investors face today is outliving their income in retirement. So getting them to save more is certainly a focus at Empower, but also making sure their assets are allocated appropriately. And that's really what we're trying to do with this program.
It requires a lot of education, though. I mean, this is an asset class which, by its very definition, is more risky because of the illiquidity. Ed, I'm sure you've heard a lot of the criticisms that this isn't set for a retail audience because of some of that concern. What is your response to that?
My response is that I trust the fiduciaries, which are the plan sponsors and their investment advisors that ultimately are going to make this determination. And then the retail investor themselves, the individual investor, will make a call as to whether they should allocate a portion of their investment dollars to these types of investments. I would put my trust and faith in fiduciaries over Washington bureaucrats to make this decision. And look, I think if you reflect on where we are today, private assets have been available to institutions, to sovereign wealth funds, to ultra high net worth, to pension funds for decades. And the results speak for themselves. And with 90% of the companies in the United States today, with revenues over 100 million, being private, and we know that's where a lot of the innovation is coming from, and that's where the growth is coming from, why not give 120 million Americans access to those companies? Today, they don't have access. I see it as a populist effort, if you will, democratization of private assets in a way that I think will really benefit the end user.
Well, maybe some of the senators who often are on the more populist camp have had other thoughts. I know you've had back and forth a few letters between you and Senator Warren, the latest of which I believe was around in July. Have you still been in communication with the senator? Have you relieved some of her concerns? Where do you stand on that?
Well, I can't speak for Senator Warren. She can speak for herself. What I will say is 9 United States senators have signed on to this effort. And have supported the Trump executive order. And I suspect we'll see bipartisan support over time. I think the concerns that have been highlighted around liquidity, cost, are fair concerns, but I know there are solutions and answers for all of them. And keep in mind, there's tremendous concentration risk right now for individual investors in the public equity markets. If you look at the S&P 500 through the end of July, 40% of the value, the highest ever, is from 9 stocks. That's the concentration risk that many Americans are facing in the public markets. That's the highest ever. And so, and by the way, 9 of those 10 companies have market caps over $1 trillion. So think about private markets as a diversification play. Maybe allocating 15 or 20% of your assets that are set for a long-term horizon into the private markets. Liquidity can be accessed through the other 85% of your assets that are in public equities. So I think we've solved a lot of those challenges, Dani, and I think you're going to see acceptance. And I should note, by the way, we have 200 clients already that are either in implementation or are offering this today. They're offering private assets today. That's without a declaration from the DOL and without clear guidelines. So I think the adoption will be somewhat tepid in the early days. But if I look out 10 to 15 years, I could see individuals like you and I who have 401ks, defined contribution plans, having exposure up to 30 or 40% of our assets in private markets and 60% in public.
And it does really change the market, though, because you have a private capital environment that is sitting already on huge amounts of dry powder. It increasingly seems to be more money chasing fewer deals. If you open this up to retail, that's even more money chasing fewer deals. You talked about the strength of returns, but is there a real risk that some of that edge is eaten away just by the very sheer size of what this market represents to private capital?
I mean, that's certainly a concern that's been raised, but the way I think about this is I'm not one to make a judgment about timing. To me, it's a philosophical argument. Is this the right thing to do? Do we believe it's the right thing to do? And think about it over decades. I just shared with you the return profile of private equity over a period of 20 years. We're not looking at this over the next 12, 18, 24 months. We're looking at it from a longer term perspective. Let the retail investor benefit from the illiquidity premium associated with private market investing. I think that makes a lot of sense, and we're going to continue to advocate for this.
And we are very much so looking forward to following along and seeing how things evolve. Thank you so much for coming in this morning. That is Ed Murphy, the CEO of Empower. All right, that's private markets. Let's get a check on public markets this morning because you are looking at a rally continuing to pick up steam. The Nasdaq looks to be at the highs of the session with about an hour into your trading day, up 0.9%. Again, the outperformance continues to be driven by Google, by Apple, and you see the S&P 500 that is up 0.5%. Bond yields, that rally picking up some steam too after the JOLTS data continuing to show a labor market that's hiring is not as robust as one would hope. We're going to get jobs data later in the week too. Yields down by 4 basis points at 421.87. Coming up on the show, Macy's impresses, Dollar Tree disappoints. We're going to have more on those results coming up next. You're watching Bloomberg Open Interest. Two retailers on the move this morning, but with different fates, Macy's and Dollar Tree. Macy's rising after reporting its best sales growth in 3 years. Dollar Tree falls on a murky second half outlook. I'm pleased to say that joining us is Sucharita Kodali, retail analyst at Forrester Research. Sucharita, really wonderful to see you this morning. If we can just start on Macy's, because it is a beat and a raise for them. What did you make of the results?
Yeah, it was a pleasant surprise, and I think that's why you saw the numbers go up. They hadn't necessarily had a great year leading up into the numbers from this quarter. It's surprising because the summer months usually aren't a time that you're going to see any type of a swing in one way or another. But yeah, I think it was a pleasant surprise to see anything that was better than expected, and that's the results that you have. It also potentially points to some big question marks around whether or not a lot of these tariff threats are having an impact both on the retail industry as well as consumers. It seems like Macy's is an interesting bellwether, given that so much of the production of their items are overseas. So I think that this is a good signal for not only the retail economy, but also for the outlook for retail into the rest of 2025.
Macy's did talk about this idea that it's a consumer who is more choiceful at the moment. Sucharita, how much about this is just a first half, that you didn't see the full effects of those tariffs, and something that might change second half if, again, in the words of Macy, the consumer is more choiceful?
Well, the consumer has definitely been more choiceful. This isn't necessarily new. I mean, you remember that inflation has been looming over the U.S. economy for the last several years. And ever since then, the shopper has been more choiceful. That's been a significant part of the growth of companies like Walmart and Amazon. In the case of Macy's, I think that it seems like Tony Spring has really done a pretty effective job making sure that his lieutenants are managing to their plans. And that has a lot to do with making sure that your merchants are buying accurately, that they are on trend, that they are cutting good deals with suppliers, and they are marking down as they need to. And I think that that's likely what you're seeing. And it seems to be showing in their numbers right now.
To that point, Macy's said in May that tariffs, they're going to be able to offset them, a combination of selective price increases, reducing their exposure to China, negotiating or canceling certain merchandise orders. Sucharita, who has the power and economies of scale to be able to do this sort of thing when we have Walmart, who reported earnings last month saying that they were able to offset doing some of the same tactics, but still saw price increases every single week?
Yeah, I don't know that in a hyper competitive environment that the retail industry is in, that the department store sector is in, that there is inelasticity in the demand for Macy's. The truth is that if Macy's is going to raise its prices, I don't think that they have much ability to raise their prices tremendously. There may be a few items here and there where they can do so. But the truth is that the shopper is just going to turn away. We've known for over a decade now that the middle segment in retail is the most challenged. That's one of the reasons that sector companies like Kohl's continue to struggle. You're not at the low end where Walmart is. You're not at the high end either. So that middle segment is always going to have consumers turning away because there's so much competition for that consumer wallet.
Can we talk about the very, very low end? There was Dollar Tree earnings today, Sucharita, which on a surface seemed good, but they talked about a third quarter that would be little change from the year prior. They also talked about some timing oddities when it came to tariffs. What is the state of these companies that aren't just getting market share coming down from the higher end consumer, but specifically target the lower end consumer?
Well, Dollar Tree did seem to suggest that it is picking up some share from some of those higher income consumers. That wouldn't surprise me in this economic climate. I think that some of the numbers that you're seeing with their valuation right now is probably due to the fact that they may be sandbagging their outlook for the rest of the year. I think that that's entirely what analysts are likely listening to is what are your plans for Q3, Q4? What do you think is going to happen? And it sounds like they are not terribly optimistic. It's a company that's not terribly seasonal. They have so many. They have so many commodities that they're not likely going to see that the same bursts if the consumer were to do better. And at the same time, they're heavily dependent on Chinese suppliers because that is a company where so much of their manufacturing is overseas. And even if they were able to get better terms of trade, the margins that you're getting from China, we keep hearing, are so attractive that companies have no choice but to absorb some of those costs. Those companies, meaning the retailers themselves, they don't have the ability to pass it on to shoppers.
So certainly two different fates for those companies this morning. It's Dollar Tree down 7.5%. Sucharita, thank you so much for joining this morning. Sucharita Kodali of Forrester Research. And tomorrow we're going to continue the retail conversation on this program, a conversation with Gap CEO Richard Dickson. Coming up, speaking of CEOs, a lot of the C-suite seeming to be losing their job over office romances. We're going to look at the turmoil and the cost to shareholders. All of that coming up next on Bloomberg Open Interest.
I'm not quite sure what to do.
Unless you were living under a rock, you know this story. In July, when the astronomer CEO Andy Byron lost his job after he was caught on a kiss cam at a Coldplay concert, that kiss cam with a colleague. He's not alone. This week, Nestle's CEO lost his job over an office romance. In May, the Kohl's CEO was fired over an undisclosed relationship with a vendor. C-suite romances continue to cause turmoil atop some of the world's biggest companies. Matthew Boyle, Bloomberg senior management and workplace reporter, joins us now. I mean, Matthew, it's not like this is new, but the fact is really cropping up. It's like, why are these men doing this when they know it threatens not just their job, but throws the entirety of the company into turmoil?
I mean, it's funny. I asked an ethics professor this very question yesterday, and she just sort of threw up her hand. She's like, honestly, it puzzles me. Do they just still think they're going to get away with it? Do they think they're untouchable? We don't really know. You kind of have to put these guys on the couch for a little while to figure it all out. But these things still continue to happen.
You wrote also a really good story not that long ago of just how expensive it is to get a new CEO. We've had some really high-profile circumstances with that happening. Why isn't there more scrutiny? Why aren't there more companies trying to prevent this sort of thing from happening and having more clear guidelines because of the cost to the company?
Yeah, I mean, I discovered that to bring in the new Starbucks CEO, for example, it's a $130 million proposition just to get that person in the door and the former CEO out the door. You know, they want a rock star CEO sometimes. Maybe they don't do enough due diligence. I have talked to some companies that do a lot of digging around these CEO personalities, and they find that there often are red flags that get overlooked, or a red flag that's just sort of downgraded to a yellow flag, let's say, because we really want this person in the seat.
And you also wrote about these employee hotlines that I think are really fascinating, and I hadn't really been aware of these, and the fact that they're getting more calls. What does it show about, we see kind of the reported things, but what's actually happening underneath the tip of the iceberg?
Exactly. It's a fascinating, it's like a lot of elements of human resources. We don't really spend much time thinking about them, but they very much exist and they need to work well. There were 10,000 more calls to one vendor's hotline last year that I reported. And these investigations, it's great to have these hotlines, of course, but I also found, according to one survey from one of these hotline vendors, 38% of the investigations are just conducted according to suggested guidelines, and 4% had no guidelines whatsoever. Let's wing it, you know? And so if you're not doing the investigation, what's the point of having the hotline? So, yeah, and also employees think they might get retaliated against as well.
Matthew, I'd say just listening to you, after the Me Too movement, after all of these high-profile cases, it still doesn't seem like there's any real driving force to reform, to change. Is that fair, or is there anyone trying to lead the charge to say, hey, these workplace romances, they're not okay, and maybe it also underscores a lack of diversity?
It's important to remember how rare this is. Despite all the high profile, since 2017, among big U.S. companies, 2,500 CEO exits, less than 2% were due to allegations of misconduct. So let's remember, it's not happening as often as we think, despite Coldplay canoodling and all of that. But yeah, you're right. You know, it still continues to happen. So, you know, and we thought Me Too would be the end of it, but of course not. People are still people.
Coldplay canoodling is excellent alliteration. I really appreciate that, Matthew.
I do my best.
Thank you so much for joining a really fantastic story. I recommend everyone go out and read that. That is Matthew Boyle, Bloomberg Senior Management and Workplace Reporter. All right, as we head to the end of the hour, it is a market that is still rallying this morning. We are near the highs of the session so far, about an hour and a half into your trading session, up 1% for the NASDAQ, lifted by Alphabet and Apple after that antitrust ruling. Coming up tomorrow, Mike Wilson of Morgan Stanley and Katherine Pay of Franklin Templeton. Plus, don't miss this conversation. Tom Abravo, Seth Burrow, and the CEOs of Ollie's and Gap. This is Bloomberg Open Interest.